Thank you for watching this video. Today we will be doing technical analysis on the S&P 500 for the week ending Friday, September 16th, 2022. And for this analysis, we will be using stockcharts.com. That is the charting service that I use and pay for, and I will leave a link to their site in the description box below this video. My name is Rodney Constable. I have over 30 years of investing experience, including over 25 years of experience trading stocks and options. I am a former financial advisor, a former vice president of a major mutual fund company, and I am the developer and president of Simple Market Signals at simplemarketsignals.com. We will come back to this chart in just a couple of minutes, but I want to move over to a weekly candlestick chart of the S&P 500 to get a big picture view of what happened this week, and then we will work our way down to a daily and hourly chart. And I have a lot of great stuff to share with you here this week, so please make sure you stay with the entire video. It will be very, very educational. So this is a weekly candlestick chart of the S&P 500. It goes back to the 1st of December of 2021. Just gives us some time perspective, and this way we can also see the entire calendar year of 2022. So for this week, right, pretty ugly week in the market, down 4.77% just this week alone on the S&P 500, and the S&P 500 closed at 3873.33. And this candle over here on the right where my cursor is circling, that is this week's trading. And it did come on some pretty high volume. It's hard to see the entire volume bar because it is partially hidden by the candlestick there. When the market falls like this, you get these candlesticks that overly on top of the volume makes it kind of hard to see. So over the last few months here, guys, let's kind of back up. We'll do a little work on this chart and then work our way down. But we know we had this counter trend rally that lasted about 2 months, right, from our lows on June 17th. And we'll touch on that more in a daily chart, daily candlestick chart. But we had this it lasted almost exactly 2 months. Really nice, really little rally here. And a lot of people thought that this was the end. And I've always felt like that was a little too convenient, right? You never can guess what the market's going to do, which, again, guys, is why it's so careful to deal with facts, deal with, and tamp down the emotions. And so with that, bear with me for just a second while I share something very, very important with you. Warning. Human emotions are an investor's enemy. Do not listen to people who use the word crash in their videos or dialogue. Crash is an emotionally charged word that cannot be quantified. Deal with facts. Avoid emotional investing. All right, so guys, please, let's deal with the facts, right? And that's what I do on this channel. That's what my business is all about, simple market signals in the stock market. I'm a very pragmatic guy. You will never hear me use the word crash in my videos and talk about, oh, the market's going to crash, because it's irresponsible, it's emotionally charged, it's clickbait. So, let's deal with the facts, and that's what you're going to find with me on this channel and with Simple Market Signals. I'm a fact-based, pragmatic guy, and I've been at this a long time, okay? So if you're new to the channel, welcome. Make sure you hit the subscribe button and ring the bell there so you get notified whenever I post a new video. So, again, we had this 2-month rally, and we got rejected right here at this downward trending 40-week moving average. That's this green line here, guys. And whenever you see a 40-week moving average on anything, I don't care if it's an individual stock or whatever, but especially on something like the S&P 500, and that 40-week moving average is downward trending as this is, it's not good, right? You don't see this very often, and really in more serious sell-offs, okay? And that's obviously what we have. But we got rejected, as you can see here, in the middle of August, right there at that 40-week moving average. And then, of course, we had 3, down weeks. And remember, the market takes the stairs up and the elevator down, okay? It's an old saying on Wall Street, but the market, it crawls up, right? Takes the stairs up and then drops very quickly. So you generally always go down much quicker than you go up. The market takes the stairs up, elevator down. We had one really nice week here, and then the market fell this week, okay? So pretty ugly week, and anyway, so let's move on. Now, I do want to point out that every sector of the S&P 500 was down this week, guys, and this is important for you. Even if you don't do a lot of sector work, just stay with me here, because it's so important that you guys understand what's going on underneath the hood of the S&P 500. If you're an S&P 500 investor, even if you're already a Simple Market Signal subscriber, right, you know that we focus predominantly on the S&P 500 because it is, a lot of us invest directly in the S&P 500. A lot of you guys do, whether it's, 401k, 403b, your IRA, whatever. But even if you invest in the Qs or individual stocks, you really need to understand what's going on with the S&P 500 because of the correlations, guys. And here's another big clue for you. A lot of people don't realize this. A lot of people will not share this with you. A lot of people don't even know this. But when volatility increases, correlations increase. Let me repeat that. When volatility increases, correlations increase, which is another reason why diversification really does not work very well in a downward market like this, and especially when we have rising interest rates, and I'll touch on that here in just a second. But this is just this week, all right? And these are the 11 sectors inside of the S&P 500, of course, the ETFs that we use to track those sectors. And look at this. Every single sector of the S&P 500 was down this week. And it's not just this week. Look at this on a year, this fiscal year to date. You've got two sectors, right? Energy up 44.29% and utilities. You've got two sectors of the S&P 500 that are positive year to date. That's it, okay? And let's just take this for fun. Let's just take this out 1 year. And guess what? We've got three sectors. Energy, consumer staples up a whopping 1.94% on a rolling 1 year basis, and utilities 13.79. And let me change this to see what's down the most in communication services, all right? Facebook, Meta is the largest holding in this sector. And that stock has been on a nosedive for quite a while, and that's really taking this sector down with it, okay? So, and again, this is on a 1 year basis, but look at this. Energy up 65.23%. I am not suggesting you chase energy. I am suggesting that you understand, right? I'm kind of a car guy, so I think about it in car terms. I have motorcycles, I've been around motorsports all my life, participated a little bit, raced motorcycles, raced cars, and so I think about these things in terms of what's underneath the hood, right? It's important for me to understand, right? When you're around motorsports, it's important to me to understand what's going on with the mechanics of the vehicle, because in some cases my life could be in danger if I get things wrong, right? If I don't understand what's going on with the mechanics of the motorcycle or the car that I'm driving or riding, okay? So it's important for you guys to understand what's going on underneath the hood of the S&P 500, even if all you do is invest in the S&P 500, okay? And right now, guys, this stuff is falling. And by the way, if you guys think that going over to bonds, now let's click over to bonds. Oh, hey, I'm a bond investor. You can't lose money in bonds. I've had people tell me this over the years, right? Remember, I'm a former financial advisor, former VP of a major mutual fund company. I've been in this industry in one way, shape, or form since 1987, guys, okay? A lot of these guys with channels out there, crash, they weren't even alive in 1987. All right. So also consider who you're getting your information from. All right. Are you getting your information from somebody that's been in the trenches for decades and can speak from experience, or is it somebody that, is just good at getting clicks? Okay. So I guess you can tell I'm on a little bit of a tirade here this morning, but some of this stuff drives me nuts. There's so much misinformation out there, guys, and this stuff is so hard. Okay. So we need to tamp down the emotions. We need to get to the facts. The facts are, in a rising interest rate environment, bonds are falling. This is just a 1 week return on some pretty popular bonds of all different credit qualities, right? We've got junk stuff in here, lower credit quality, HYG, JNK, the AGG, right? Kind of an intermediate bond. But anyway, the point is, right? Like, this is just a 1 week return. So anybody that thinks, S&P down 477, yeah, but I was in bonds. Okay, maybe you didn't lose as much, but the bonds didn't make you any money. And this is just on a 1 week return. Let's go over to year to date, guys. And again, stay with this, guys. If you really want to be a better investor, I don't care what you invest in, individual stock, Qs, whatever. Understand this stuff, guys, because of the correlation. You need to understand the bigger picture, right? Which is why I do what I do, and I love this stuff, and I'm a geek on it, and it's fun for me to educate people and share this, but you need to do your part, okay? If you're not a subscriber, subscribe to the channel. If you're not a Simple Market Signal subscriber, guys, come on, okay? It's less than 20. Here's I'm going to give it away. It's less than $20 a month, okay? And you get access to me and my proprietary information, and guys, I'm telling you, it's not an expense for most of you, it's an investment. The difference is expenses are something, you pay and you don't really get anything back, right? It's lost money. An investment is something you invest. And by the way, you are your single best investment. So if you're not willing to invest $20 a month in this example, I don't care what it is, but let's just use what I do, right, and how I, make part of my living, because I'm not getting paid, right, to do this video. It's free, right? But, if you subscribe to Simple Market Signals for, $20 a month, all right, you're getting a tremendous amount of information and tremendous amount of value, and you're getting facts, and you're getting my proprietary signals, which took me over 20 years to figure out, guys. Don't underestimate the value of what I'm offering you. And when you invest $20 a month in yourself, in your own knowledge, right, the return on that investment, it's just hard for me to believe that you're not going to get over and above $20 worth of value. As a matter of fact, I've had people, and you can check out the testimonials at simplemarketsignals.com if you don't believe me. But I have one of my subscribers that wrote me and told me that he made in last year in 2021 made tens of thousands of dollars of additional returns in his 401k that he otherwise wouldn't have made had he not been a Simple Market Signal subscriber. So you think about the ROI on that one, right? $20 a month out, tens of thousands of dollars a year in. That's a pretty good ROI, guys. Something you may want to think about. Anyway, back to this slide. So the bonds, right? This is year to date, guys. Look at this. You got the TLT, the 20-year Treasury down 26, almost 27%. LQD down 1766. Junk bonds down 1290. The J&K. You have a 3 to 7 year Treasury ETF, pretty short duration, down 896. The 7 to 10 year down 1328. These are now this isn't counting yield. I get it, but the yields on these things are so low, guys, that there's no way it's going to make up for the downturn that you're seeing here. The HYG, right, pretty similar to the J&K in its makeup, down 11.91, and the AGG, kind of a core aggregate bond fund, down 12.17, and this is just year to date, guys. Okay, let's go out 1 year and see what it looks like. Right? Not a lot, not substantially different. So to think that you can't lose money in bonds is wrong. All right? And so in my way of thinking, and again, I'm just a pragmatic guy, if you really want to be successful going forward, you've got to understand a couple of things. Cash is an asset class. And everybody, and I still watch a lot of financial shows and things. I enjoy it. I want to see what these other guys are saying. But the talking heads, where should we invest? Where should we invest? Guys, there is no safe place to hide right now, okay? There are times where cash is, for a lot of people, now, some of you, for whatever reason, can't go to cash or maybe don't want to go to cash, so you have to employ a different strategy. I get that, okay? But to the degree that you can, remember, cash is an asset class, and I learned this decades ago from a very, very smart investor and trainer in financial services. Okay, this guy was a monster in the industry, and he pointed out cash is an asset class. There are times that cash is the better option. Okay, but again, that's entirely up to you. But investing in things that are losing value, all right, I don't care whether it's bonds or stocks or whatever. To the degree that you can avoid drawdown, I don't care what you're invested in, right? If you minimize your downside and then maximize your upside, over time you're going to win, right? It's just math. It just makes sense. Which again, avoid the emotion, deal with the facts, and I can help you with that, but you got to help me help you, all right? So if you think you're going to hide out in bonds and be better off that you are in stocks, probably not. All right. Now, this let's deal with this slide here real quick. So this is an hourly candlestick chart of the S&P 500. Just goes back to August 22nd, gives us a short period of time. So this is part of that downturn. We actually peaked on August 15th, August 16th. We'll look at that here in a second. But I just want to on this last counter trend rally, right, that we had here. But we had this downturn, and what I wanted to point out, guys, is, and again, it's dealing with the facts. Okay, we're technically not in a bear market on the S&P 500. We're super close, and I'll talk about that. But we're in a serious downtrend, no doubt about it, okay? But on Friday the 16th, right, in this bear market line, 38.54.89, by the way, anything below that, I don't care on a daily, weekly, hourly, whatever. Anything below 38.54.89, and we'll talk more about that in the next slide, but is, the S&P 500's in a bear market, all right? Anything above it, we're technically not in a bear market. It's important for us to understand and be technically proficient and not emotional, right? Guesswork and emotions and opinions and that stuff doesn't matter, okay? Whatever it is, it is. Let's deal with the facts. Let's be mature. Let's be technically accurate and just accept and be agnostic with respect to the market, all right? We don't, with the way I approach it, guys, I don't care what the answer is because I just want the answer, right? What is going on? Let's just look at the facts, and whatever it is, it is. Because if we don't approach things, if we don't approach life that way, right? If we don't just deal with whatever the facts are, whether it's a health issue, the markets, whatever, we have to deal with the facts. Let's get the facts. We're never going to know all the facts. But again, this is also why I focus on the stock market, because it's telling us we invest in the stock market, guys. We don't invest in the economy. A lot of people get that all wrong. So, a lot of people want to try to read the tea leaves and, extrapolate what that's going to mean with the stock market. Well, good luck with that. I've been at this long enough. I realize it just doesn't work. All right. So I abandoned that approach a long time ago because it's just too darn frustrating for me because anyway. So, we're technically, right, so here's Friday the 16th, and the whole point about this on these hourly candles of the S&P 500 since August 22nd through the 16th of September, and what we can see here is we had on Friday the 16th, for the first time in quite a while, we had some trading in bear market territory right here where my cursor is circling inside of this circle, Friday the 16th of September, but we technically, right, 38.54.89 or below is a bear market. Again, we closed at 38.73.33. We are technically not in a bear market, but man, we are close, okay? So how close are we? Well, as of the 16th of September, this is a daily chart now of the S&P 500, and you can see here that we're down 19.62%, okay? So where we closed, again, this is that bear market line. Where we closed on Friday the 16th, we're down 19.62%. So we're super, super close to a bear. Remember, a bear market is when you're down 20% or more from your all-time high. Well, the all-time high on the S&P 500 right now stands at 48.1862 up in the upper left of this chart where my cursor is circling. And, we had that intraday reversal, sold off, and that really started this downturn. And the lowest point of this downturn is at 36.86.87, which we hit on June 17th, intraday. Okay, so we had an intraday reversal at the top. We had an intraday reversal so far at the bottom. We had that counter trend rally that we've already talked about, took us up to just over 43.25, and then we've been falling since. Now, guys, it would be reasonable to expect the market to go lower. Do I think it, and again, I'm not trying to make prognostications, but do I think it's highly likely that we undercut this 36.86.87 area over the next month and a half to 2 months, maybe sooner? Yeah, I think it's quite likely, all right? But remember, when you're pushing down on the market, it's like pushing down on a spring. And at some point, that spring is going to bounce back. Now, so far, these bounces, right? We had a bounce here, we had a bounce here, bounce here, bounce here, bounce here. This was the big one, of course, that lasted 2 months. But these are counter trend rallies, right? The trend, and let's use the simplest of all technical indicators, and you connect the bodies of candles. In this case, we're going to go with the bodies of daily candles. And just across there here, and let me save my work. So we can see here that the, sorry, I had to get that chart back where it needed to be. But we can see, right, just using a simple downtrend line, right, we came close, and we know that, we got right up to that 40-week moving average back here in the middle of August. And now we're taking a look at this on a daily, and you can see that also, correlates quite strongly, right, this 40-week moving average to where this downtrend line is, All right. And now we came right down to this bear market. Now, remember, guys, the bear market line. And you can see there's the trading so far. So have we been in a bear market during this downturn? Yeah, we were down about 24.58%, I think was the exact number from peak to trough. You guys can run the numbers for yourself and figure that out. But we were down from peak to trough so far about 24.5%. And we spent a few days, right? And we've had a few weekly closes in bear market territory underneath this 38.54.89 line, but then we rallied back above it. So right now we're technically in a correction, not in a bear market on the S&P 500. If you look at the Qs or other things like that, the triple Qs, things that are higher beta, yeah, there's a lot of those things that are down more than 20%, a lot of stocks down more than 20%. So all of those things are in a bear market, but technically the S&P 500 is barely, right, by 0.38%. Still out of a bear market, but that could easily slip next week. So next week, and remember, Friday was options expiration, and so we had a lot of volatility, a lot of volume that could have affected the trading on Friday. We'll have to see what next week brings, but remember, we're also in the worst 3 months of the year for the stock market historically. August, September, October, and October, a lot of times, not every time, but a lot of times October will end up being what they call the bear buster. And so if the market is in a position to bottom, it oftentimes will bottom in October. There are times that it'll bounce and go back down, in say March and hit either really close to the same low or that it hit in October or undercut slightly and get that technically accurate double bottom from October to March ish time frame. You can go back and look at older some charts over the last few decades and you'll see that. But nobody knows what's going to happen from here. But these are dangerous markets. I hope you'll seriously consider looking at not only subscribing to this channel so you can get more videos like this, but also, guys, please, think very hard about investing $20 a month in your own gray matter and becoming a subscriber to Simple Market Signals. I'm going to tee up a little bit more video here for another couple minutes and give you a little bit more information. But guys, this is for most of you, it is not going to be an expense. It's going to be an investment, okay? And it's going to help you. It's going to save you time because I'm doing all the work. I'm doing a lot of technical analysis. Plus, I'm giving you access to my exact signals. I don't give you the formula. It's proprietary. But I give you the signals that come from the Simple Market Signals proprietary model for less than $20 a month, plus a bunch of technical analysis, plus a bunch of other education. Guys, I mean, for the right person, it is a smoking value. Okay, and to me, it's an absolute no-brainer. So the reason I'm beating on this so hard in this video, guys, I'm just trying to help you. This stuff is so hard, right? And people can get so emotional about it, and it makes me crazy that there's so much misinformation out there. And I just want to help you. Okay, so help me help you, and the start of helping me help you is for you to watch the rest of this video. Do you manage any of your own money, including in your 401k or IRA? Are time and money important to you? If time and money are important to you, then Simple Market Signals should be important to you as well. Simple Market Signals is for business owners, busy corporate executives, and other professionals who want to cut through the stock market BS and get down to the facts. If you value your time, if you value your money, you need Simple Market Signals. Simple Market Signals is based on a proprietary formula developed by a former financial services professional with decades of real-world experience. Simple Market Signals is equity investing information simplified. Simple Market Signals saves you time and helps you understand market trends and risk management in a way few enjoy. Just try it. There's no contracts. You can cancel anytime, and a subscription to this information is less than 67 cents per day, and it's priced way less than it should be for the value it brings. To learn more, go to simplemarketsignals.com and watch this video that's on our homepage. So again, go to simplemarketsignals.com and watch this video that's on our homepage. Again, that website is simplemarketsignals.com.